Now, with that said, I'm not a financial advisor, but I also probably make more money than most financial advisors. So take it for what it's worth. Okay. All right. I mean, like for real. All right. I'm not a financial advisor. I'm not an accountant. I'm just a dude that has made money. He's lost a lot of money. He's made money and has tried a lot of different things. And this is just going to be an episode of some of my regrets and the good, the bad, the ugly of them all.
This is Secrets for Success.
Welcome to the Secrets for Success podcast. I'm your host, Greg Todd. Thank you as always for joining me. Today, let's talk assets. Not all assets are equal. And that's what I want to discuss today. And I don't feel like I could have ever done this podcast until now because I have different assets. And I really want to talk to you guys about which assets make the most sense for you. And I think everybody's situation is going to be a little bit different, but now I've had enough experience with building assets that I think by the end of this podcast episode, you're going to know which one makes the most sense for me. Okay, now before I even start that, let's talk about that. Basically, building assets is extremely important. Okay. All right. You guys have probably heard me talk about the 30-40-30 rule. It's something I learned at a T. Harv Eker conference back in 2011, I think. And it was understanding that if you wanted to be able to build wealth, it's probably in your best interest to follow the 30-40-30 rule. 30% of your money should be spent on your expenses, rent, mortgage, car, this, that, da, 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 da. Okay. 40% you allocate for taxes. Okay. And 30% is, again, if you're looking to build wealth, 30% should be allocated for building your assets. Okay. And so I know that number's like, what? That's crazy. I would never. Well, listen, those are the numbers. That's what I was able to start doing. Once I left that conference, I did not have the resources and the means to be able to put 30% of my money for asset allocation. But over time, because I was aware, I said, I'm going to start working towards that. I started doing it about a year and a half later. I was able to get to that 30%, and I've been able to keep that, and it has done wonders for my life. So, and so I'm telling you all right now, building assets is important. Now, the question is, what type of assets should you build? Okay. So, a lot of times when we think of assets, we think of businesses and we think of real estate, right? And there's businesses, there's real estate, maybe 401ks, if you want to call that an asset, but basically like anything to where your money is working for you and you aren't having to work for the money. All right. Technically. All right. So that's what an asset is. And what I want to share with you guys is my history of building assets. Okay. And kind of some of the good, the bad, the ugly with each of these types of assets. And I think they all have their purpose. I just think that sometimes people have an agenda and they push, oh my gosh, this is the way to go. And there's kind of pros and cons. All right. Now, with that said, I'm not a financial advisor, but I also probably make more money than most financial advisors. So take it for what it's worth. Okay. All right. I mean, like for real. All right. I'm not a financial advisor. I'm not an accountant. I'm just a dude that has made money. He's lost a lot of money. He's made money and has tried a lot of different things. And this is just going to be an episode of some of my regrets and the good, the bad, the ugly of them all. All right. So what I want to do is let's talk about three different types of assets. All right. So the first one I want to talk about is real estate. Okay. I think too many people try to get into the real estate game way too early. I believe that I was one of those people. It backfired on me dramatically. I believe real estate serves its purpose, but I think that today's market, real estate is not what it used to be. All right. So let me first share a story with you on how I absolutely butchered this. In 2005, when I decided that I wanted to be a business owner, I didn't just do one asset. I picked up 3 assets, or so I thought, okay? I took out a $180,000 line of credit loan on my house. I allocated, it was like 80,000, 70, 80,000 to renewal rehab. That was an asset, a business. Okay, great. Okay. By the way, I was doing this off of borrowed money, right? Okay. All right. So call it 80K with renewal rehab. Okay. All right. Then I did 20K with Forex trading. It ended up being a Ponzi scheme. It was a total joke. It was a disaster. I lost 20K, never got that money back. Okay. And the remainder of it, I put into a townhouse that I bought in I guess it's 2026. It's a brand new townhouse in an area called Valrico, Florida. And I bought it with my dad. Okay. So that's what I did. And let me tell you, let's start with the Ponzi scheme. Here, ready? Here's my lesson with that. Just don't join Ponzi schemes, and anything that is you're going to 140x your money over 8 months, whatever, just know that more than likely it's too good to be true. So anyways, learn my lesson there. Okay, great. Now let's talk about the real estate piece, okay? Because I think the townhouse was like $190,000, like close to $200,000. This is in 2005. So remember what happened in 2006? Remember, the market was massively inflated, the bubble burst, and I held on to that place, but I did it with my dad, and he basically told me about a year and a half later, he's like, I can't afford this anymore, so it's kind of on you. And it was in my name, so I just had to deal with it. So I paid it, and I had somebody renting it, and I couldn't make it work. Meaning that my mortgage payment was just it was so much that I couldn't get somebody in there to rent that place, and it offset my mortgage payment. So I ended up having to eventually short sale it, and it ruined my credit. Okay. And so I'm saying this to you all for this reason. Okay. And by the way, ruining my credit was one of the best things that happened to me, because as somebody that had a middle-class mindset, um, I did everything to keep great credit. And I realized that, I mean, great credit's cool, but it's just really good showing that you pay your bills on time. And and it wasn't the end of the world. And it made me, I think, made me a stronger entrepreneur. By the way, I'm not recommending for you to go and ruin your credit, okay? But I think it did make me a stronger entrepreneur, knowing that I've now seen, like, if you lose it all, this is what's going to happen. And honestly, it's not the end of the world. And so it made me a lot more aggressive, made me take more risk, et cetera, et cetera. So with that said, let me tell you my lesson on real estate. I believe that many people are trying to use real estate to generate passive income. I don't think the numbers work out for the majority of people. All right. So I'm going to break down a couple of things for you. I want you to think right now of, if you are going to do real estate, okay, like, how are you going to actually make this thing work? Okay. And now I'm just going to give you, because I'm in real estate today. I have commercial properties, and I have a few residential properties that I use as short-term, rentals. Okay. So I just want to share with you, like I know, you know, the sides of this. I've seen it not work for me. I've seen it work for me. Okay. Today, I think that most people, with the way that the interest rates are, I don't think you're going to be able to get into a property unless you put down a massive down payment. I don't think you're going to be able to get into a property today. In most cases, I know there's some outliers, but I don't think you're going to be able to get into a property today with the prices of houses, with what the interest rates are, and be able to turn a profit by renting either long-term or even short-term. Okay. Now, let's break this down. If you buy a property right now, let's say you buy a property for $300,000. Okay. Typically what they tell you is for every $100,000, that's about $1,000 in your mortgage. Okay. So you get a $300,000 property. It's probably it's probably a little bit less, but somewhere between $2,500 to $3,000. Okay. The question is, can you rent it for that much? And if you are going to rent it for that much, how much more can you actually rent it for than what you're paying in your mortgage? It used to be pretty darn easy to do. Today, with the interest rates the way that they are, with the way that the housing market is, that doesn't work very easy. Okay, now let's talk about short-term rentals. Short-term rentals, you can make a lot more money. Here's the problem. They're changing things in so many different cities. A lot of people don't want Airbnbs anymore in their city. So it's a risky business. Guys, I am seeing this. I'm seeing this in Indian Rocks Beach. I'm seeing this in certain parts of Georgia. Luckily, right now in Blue Ridge, like we're good. But this is happening. People are like, we don't want people coming in and coming out and not taking care of our communities. So it could be here today, it could be gone tomorrow. I'm just, guys, I just think that building an asset in real estate to make passive income and to like increase your earned income I just don't see it as a really, really good option anymore. Now, what I think real estate is amazing for is tax mitigation, meaning that, hey, I've got a property, I can write off the taxable interest, I can write off I can write off the property taxes, I can write off the depreciation of the property. I think that is wonderful. I think that's great. But for many of you that right now, your biggest issue is not getting rid of taxes. Your biggest issue is you don't make enough money. Your value in the marketplace is just not there enough to where you're making a lot more money than you're spending. I would not use that. I would not get into real estate as my primary way of building assets to start. That's it. This is just me now knowing what I know today. What I would do is I would go into business assets. Okay. Now, business assets before and when I started my business in 2005, that's a $80,000 business that I started. Today, you can go online. Today, you go online. You can get started, honestly, for less than $1,000. Like you can have a legit online business for less than $1,000 starting, okay? What you need online is you need some guts. You need to have a little courage. You need to let go of all the things that your mama and your daddy and your auntie and your uncle said, that you ugly, that you got big teeth, that you got a big forehead, that, they used to say, I got a mole on the side of my nose, like all them things. I don't give a rat's, I don't care. I just say whatever the hell I want, when I want, how I want. I'll pray if I want, I'll curse if I'll do whatever I want to do online. But if you don't have that, then, well, you can't do online. But the one thing you don't need is you don't need a lot of money. Okay. Now you might want some coaching. You might want this. And like if people gonna want to cut in my crib, you got to pay some bread. But like, shoot, I'm doing a challenge, March 24th to 28th. I do it for free. Like just do that. Okay. And to get started with an online business, honestly, you can start it for less than a couple $100s and you could be well on your way. Okay. So that's what I think with regards to at least the real estate game. Okay. Now, there is also all right, I'm going to invest, whether it's in ETFs, okay, stocks, 401ks. These are you investing in other companies. Okay. And depending on which one you do, like 401ks, usually you're investing in a fund, right? A mutual fund. You're investing in a fund. All right. And those are multiple companies together, right? And so, yes, you can make money. The problem with like a 401k, problem with most mutual funds is that there's penalties if you take that money out before a certain age, right? There's a penalty for it. So it's not usually the best ways for you to be able to generate income because there's penalties if you are not of the appropriate age to be able to take it out, right? And then when you take it out, you're going to get taxed on most of it anyways, okay? All right. And then I just feel like with stocks, okay, you will only get taxed on what you take out and there's no penalties, but you're now investing in other companies, okay? And by the way, it's not bad. I do it, but I don't want that to be the main way that I'm building an asset. I would rather build an asset that is based on what value Greg Todd can give. So to me, if I was doing something today, it would have to be real estate or it'd have to be business as an asset to build. And since real estate, I know, is just a much slower play, it's a much slower growth, and it's more for taxes, I would put my money that I am setting aside for assets into businesses. preferably online businesses, because they are a um, much easier for startup. It just doesn't take as much money. Uh, and that's the way that I would go. That's the way that I continue to go. For me, let me tell you what I do. Okay. I use my businesses to be able to fund my real estate. That's what I do. Okay. So my businesses fund my real estate. So my first property that I did this with was in 2016. It was a property that I had in Indian Shores, Florida. Okay. And so here's what I did. That property, I mean, I got a really good deal on it. I think I paid I had a 3.5% interest rate on that property. I paid just over 500 grand for it. And I think all in, I was like $3,000 a month. Okay. So here's what I did. I wasn't really able to rent it out, but what I did is I had 3 businesses. I had SSPT, I had Renewal Rehab, and I had Smart Virtual Staff. And what I did is I would use those businesses and split it between those businesses to pay for the property. Okay. What I did at the property was I would host clients at the property for those different businesses. Okay. So if there was a client for Smart Virtual Staff, which is our virtual staffing, agency, which mostly my employees were in the Philippines. Okay. If there's most of the clients were in the US. So those clients, I can have them come to that property and we can hang out. We can talk business, this, that, da, 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 da. That company's got to pay for it. Okay. All right. Same thing for SSPT. SSPT, now SSHC. If I had clients come to the property, we did like a little retreat. We did this, we did that. SSHC, SSPT had to pay a portion of what the rent was for the property. So I knew that every single month. And then Renewal Rehab, same thing. If I had physicians, I had other businesses, I had people that we were doing stuff with, we can actually host them at the place, and then Renewal Rehab's got to pay for the property. And so what that allowed it to be a win for both my business, because now my business was paying for the property and that was an expense on my business, but then it was able to feed into another business. So now I knew that there would always be rent. I knew that the mortgage and then some were always going to be paid. So I was able to keep that property from 2016 to 2021, 5 years. Okay. And I was able to walk away from that property with $320,000 in equity. That was my check. And then I was able to take that check, turn it into a 1031, and then now go and get another property, and then get another property, and then get another, and just rinse and repeat that. So if I'm doing real estate today, I'm using my businesses, my assets in businesses to basically help to fuel the real estate, to make sure that I've got that place rented out. That's what I'm doing. And then short-term rentals, this, that, da, 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 that can just be little add-ons, to it. Guys, that's how I'm doing it today. That's it. And I truly wish somebody would have given me that game. It would have saved me hundreds of thousands of dollars that I lost just because I didn't understand it. So here's the deal. If you have a lot of money, go get yourself some real estate so that you're not paying as much in taxes. To me, that makes probably the most sense. Okay. All right. Sit on it. I make some mistakes in my clinics. I never got the real estate of where the businesses were. And that came back and bit me in the butt with the clinics. Okay. I would do that today if I was you. If you don't have a lot of money, I don't think real estate should be the way to go for you. I think that you should try to build your assets using businesses, preferably online businesses, because they're so easy to pivot. It allows you to be able to scale and help people outside of your communities. You don't have to worry that you live in Iowa or you live in Wyoming, or it doesn't matter. Like it's fair game anywhere. And then I would eventually get property, and I would use the business to be able to help pay for the properties. That's what I would do if I was to do it all over again. That's what I'm doing now. And I think that's definitely the way to go. The one thing I will say to every single one of you is you want to build an asset. You want to build assets, because at some point, Father Time will catch up to you. At some point, you will just run out of energy. And um, and you need to be able to have the ability to pivot, and to have the ability to be able to just shift. based on the market. I think it's really, really hard to do when you are primarily brick and mortar. It's just really difficult. So anyways, I hope that helps you guys. I'm going to be doing a 5-day event where I'm going to show people how to actually build online businesses primarily. We'll show one way to build a brick and mortar business that if I was doing it today in the healthcare world, how I would do it, but primarily online businesses. It's going to be called the Path to Goal Challenge. It's going to be March 24th to 28th. I would love to see you there. And if nothing else, I want you to take away from this episode, build assets. Assets are the way to go. Build them, grow them, and get to the point where your money is working harder for you than you are working for it. I hope this helps you guys. Till next time.